Hey guys, Mike here. So I got a video for you today, which is it's loaded with data, but you know me, if you've been following the channel long enough, I am a firm believer in not getting caught with your pants down and depending on, hedge funds and everybody else to either lie to me or mislead me in any way, shape, or form. So again, here on this channel, we don't have an agenda. We're just putting information out there. I'm putting it out there. And, with sometimes the members' help, with your help, stuff like that. And so some of this stuff actually came from you guys. So I vetted it and looked at it and I said, I think it's important enough to, at least put out there. So that way, you can not be surprised if something negative happens in the market or something positive for that matter. Okay. And so just keep that in mind, because if this data I'm going to show you, if it continues to get worse, and finally, when we get out of this multiple expansion and we go into earnings, that's where they're going to feel it at, right? In earnings. And if the market perceives and sees something coming, they will sell the market back down. Now, I'm going to show you a chart, which you need to have, okay? Put alerts on it, whatever you want to do with it, right? But it will show you, it can kind of give you a guideline to say, well, if we do sell off, where are we going? And if we do move up, where are we going, right? And this kind of can give you a little bit of a hint, okay? I think it's extremely important to know. And so, I'm just going to start off in this data. Again, some of this came from you guys, some of it came from the members, some of it came from my research. And so let me know what you think down in the comments. And some of it was kind of shocking, actually. But, when you look at, obviously, where is sentiment, right? This is the AAII members feel about, where do they think the market's going to be 6 months from now? And you can see, still bullish, but you see right there in the middle of the neutral part where people kind of like a third of them are going, I don't know where it's going to be 6 months from now, and of course, why are they feeling that way? You might be one of these folks, right? Well, you're seeing things you just never seen before. Here is rent versus income growth. Look at the divergence. We've never seen this in the 21st century. It is a bigger spread than we've ever had between what rent actually is and what people's household income actually is. And you might be feeling this pain too. And you can see it just slightly increasing over time there. But once 2020 and 2021 hit, just skyrocketed. It took off. Now, the one stat I don't understand, and I've thought long and hard about this, maybe you guys can help me with this. U.S. rental vacancy approaching highest in 5 years. So that is vacancy rate. So the only thing I can think is, one, I know they are building apartments like faster than we've ever built them before, okay? Two, a lot more people are staying at home, especially the young folks. I got a neighbor whose kid still lives with him because he just can't afford $2,000 to $2,500 rent for a 1 to 2 bedroom apartment, okay? And, but I figured this would be less just because of the housing inventory and how much they cost and how we know demand has been much lower because of prices and stuff. So let me know your thoughts on that one right there. Then we go into Federal Reserve consumer credit. This is the non-revolving. This is your student loans, your car loans, things of this nature, right? And you just see it's falling off a cliff. I mean, absolutely falling off a cliff. And for the first time in a long time, seems like it went negative, right? In 2020, it went negative. We shut down the world. 2011, but you see it rarely is negative, but it just hit negative for the first time in June. And so that's kind of surprising, right? And not a good thing, I would think, if you think about that, but it's obvious for reasons why. I mean, why this is happening. The next one is total consumer credit expanded in May by 7.2 billion, which is good, but guess what the estimate was? 20 billion. So not good. Guess what the month before that was? 20 billion. So that shows you, and you look at this tail, it's decreasing, right? And so obviously, what is our economy based off of? Debt, credit, this kind of stuff. That's how it goes, right? And so, but we expect this to keep happening because of rates and things of this nature. Now, then you got bank credit, all commercial banks. Well, you can see this thing, the only time it's been any lower was in the financial crisis when we obviously almost lost our financial system because of all the shenanigans the banks were getting into, right? So not good, okay? But again, is it shocking? No. And again, should this get worse? Absolutely it should get worse. We just had a bank's report, right? And so what the banks say, they're putting back, just like for commercial loans, much more money because they expect a lot more problems in the commercial banking industry. Now, of course, why is this a problem for small businesses, which is the majority of America? Because regional banks hold 80% of commercial loans. That's why you saw some of the banks, including PACW up there, get rid of their commercial loan arm. I'm thinking altogether, honestly. They took a big haircut on it. But they're doing everything they can to offload these to the bigger banks, right? For nickels on the dollar, I'm assuming, or pennies on the dollar. But we'll have to see. But this is a big thing to keep in mind, especially if you're a small business owner, because I'm hearing this a lot from you guys. I'm listening to, obviously, there's a lot of presidential, people running for president, running all over the country, and they're hearing it from small business owners that have been through a lot in many, many years, and they just cannot get the capital. And if they can, the interest rate is so high on it that they just can't afford it, right? Because we've proven, I mean, the economy, as much as we're spending, and guys, before we continue, if you get anything out of this, please hit that thumbs up down there. I really appreciate it. And if you like the material here and the videos, think about subscribing. All the growth, if you want to call it that, is because these companies, just said it last week, they keep raising prices. Okay, that will come a point in time where they just won't be able to do that because we just won't be able to afford it. There's no way that the income is going to keep up with how much they're raising the expenses. And I'm going to touch base on that in just a few minutes and stuff. And so, you know, and again, I'm a proponent of small businesses. Obviously, I mean, I have a business. This is a business, believe it or not. But there's plenty of people out there that own, you know, either grocery stores, you know, small construction businesses or whatever. Many small businesses, right? And I'm hearing all the time how tough it is, even when they can get the financing. When you're paying 3 times as much interest you're used to paying, and you're looking down the road going, man, how long is this going to last for? Is it going to be for a year? It's going to be for 6 months, 2 years? Like, how long, right? And so, unlike these big conglomerates, they don't have to worry about that kind of stuff. They got billions in cash on hand, okay? And they get much better deals for their loans than these small businesses. So, again, my heart goes out to people with small businesses. If you know, heard the same thing or you're feeling the same thing, you know, put it in the comments. And of course, what else is going to start kicking in? Assuming people are going to start paying this in October, we'll have to see. It is going to be what's basically either the second or third largest bill, whichever one you have in your household here, is going to be student loans, right? And so that's going to be interesting to see how it works. We'll have to figure out the reports when they start coming out to see how many people are not paying. Because if people aren't paying, it's not because they don't want to. It's just strictly they can't afford to. So we got to figure that out, see what's going on. And again, because that's going to affect just a lot of folks, and we won't know until we get the data. Okay, it's just that simple. I put this in here. This actually don't even matter, but the fact, I'm always amazed by this, that we just put on $1.08 trillion onto the debt in 30 days. Am I the only one amazed by that? $1 trillion to the debt in 30 days. Like that's just mind-boggling. But again, a lot of people out there, you know, say, hey, deficits, debts don't matter, right? We run up to 100 trillion. Don't matter. So, and again, we'll find out. At least my kid will. I'm not sure about me. But, you know, the other thing we got to keep watching now, right? Energy, right? Everybody is looking at energy, oil, natural gas, things like that to see if we start getting price hikes. You see XLE tried to bust out, got rejected at 200. And again, we'll see if this starts moving back up. But when you look at oil itself, because you know the big cartels, they're trying to cut back their production to actually jack the prices back up, or at least maintain them where they're at and stuff. So we'll see if it gets a bounce. Obviously, when you look XLE versus XLK, this is obviously energy versus tech. You can see it's right at a very pivotal trend line here for a bounce. This is when you usually do get bounces and stuff. So we'll see. When you look at oil, obviously it's at a pivotal point right now to see if it is going to get a bounce or not. I'm at the mindset, you know, I'm like, wait a minute. The cartels already cut back production and everything and output, and it didn't really affect the prices. But if this continues to go on and all of a sudden oil does start getting a pickup here, you know, what's that going to mean for gas prices, right? Obviously, I hear a lot from you guys about gas prices. Even though they have dropped off a cliff compared to where they were at, they're still very high when you look at the historical measures here, okay? So, I mean, we were used to what, like 250, somewhere in there? If you're looking at that, maybe, and we're still sitting at, you know, a national about 355, I believe it is. In my area, it's in the threes and stuff. And so, again, that affects, you know, mostly middle class and below. But again, everybody seems to be really upset about that one. And I do want to say this real quick, that inflation, I understand, I think a lot of people were confused about this. Like, you got to understand, here's a great example I found on the internet. And it's like, understand this. If something costs $100, right, and then it inflates 9%, that gives it, obviously by the end of the year, you're talking about $109, right, in year one. Well, in year two, we're starting at 109, not 100, right? So then the 109, let's say inflation drops to 3, which is where we're at for headline inflation right now. All of a sudden, at the year end 2, now all of a sudden we're at 112.27. And so when it comes to everything we're paying for, you know, that's what I'm talking about. I haven't been through this in a long time, so it's like, or, you know, seen prices jump this fast. You know, when you're looking at everything else, all of a sudden prices were here and they just went, whew, like it seemed like really fast, right? And so it's not that prices are coming down. Some prices are coming down for things, but the increase in the prices is what's coming down, okay? So you might still be saying, well, this is really expensive, because it's still going up. right? It came way up here, right? And so the price is here now. Now instead of going up 9% every year, it's going up 6%, and then 4%, and then 3%. Okay, so that's what's happening. The big danger is that the prices stay elevated, like really, according, when you compare them to historical prices, and all of a sudden somehow wages start coming down. That's what you don't want to see, because then what happens? You're really going to be in a hurt like then. And so, and remember we talked about the Fed raising rates. Not only do they want to bring down home prices, what does it seem like they want to bring down? Because inflation is coming down or whatever, even the way they calculate it. But they want to get people unemployed, because you think these companies, especially the fast food restaurants and all these service restaurants, are happy paying these kind of wages to people? Are you serious? You think they're happy paying teenagers 15 to 20 bucks an hour? No. They know that's unsustainable, because they can only raise prices on those burgers and sundaes, so much. And if you want to do a great exercise with your kid, by the way, to see if they really understand the concept of money and just have something fun to do with them, so they have to do some math and everything, just talk to them about a McDonald's sundae or ice cream cone. They all know about that, right? Have you seen how expensive those things are compared to what they were in 2019, just in that 3 years? And obviously, as adults, it's chump change to us. But when you're a kid, I don't know what you pay your kids. Maybe I'm, undercutting my kid. He's 7. He gets $5 a week, right? So let me know, and you can go ahead and troll me if you want to. Maybe it's supposed to be more because of inflation. But again, when you're talking about on average, you're making $20 a month or $5 a week, and the freaking cone, it's the sundae, in my area costs $3.25 after taxes. Well, if you're only making $5 a week, $3.25 is a lot of money for one sundae, right? That sundae in 2019 used to be $1.79, so it's doubled, right? And they keep raising it up, which is crazy to me. But if you want to do some math with your kids, and then what you do is you talk to them and say, hey, how can we go about getting a sundae, but getting it cheaper, right? And then walking them through the problem solving contest. Like, oh, well, what if we bought from Walmart or wherever the ice cream and the hot fudge, and what would that cost? And And you go through the math. And I'll give you the math for you, by the way, because I did it with my son on the board. But it actually equates to a sundae. If you bought the stuff we looked up online, it would cost 50 cents, right? Not $3.25 for one. So then we go through what he can save, and all of a sudden you're like, wow. Now I make $5. I spend 50 cents if I just do the one a week, versus making $5 and spending $3.25 of my money on that sundae. Now again, I don't make my son buy the sundae, but it just it gets him working. And when you look at it in that perspective, and then you do it from 12 months out, it's pretty crazy math. For a kid at least. I was pretty amazed by that. I was trying to think of an adult analogy on that, but I couldn't come up with one. But let me know if you can, so I don't let it go through it. But that's the kind of stuff we're talking about when it comes to inflation, wages, all that good stuff. So, and again, I talked about that last year. I said we're going to come to a point with inflation where it's not so much just the underlying inflation; it's these companies that they just keep on going and going with these price hikes. And then when are we going to say enough's enough? That's really what it comes down to. When are we going to say this is just too much? It's just too much. And so we'll see. Now one more thing, and then we're going to get to this chart. Obviously, they're supposed to do the rate hike. So if they're doing the rate hike, that should put us past what we saw in 2006, 7, and 8, okay? So then we should go back to a rate we ain't seen since the late 90s, right? So be the first time in the 21st century we've been somewhere at that level. So we'll get to see how the economy is going to handle it, and if there's going to be these delayed effects we keep hearing about. And it's just taking longer because there's so much money in the system and still being pumped in the system. But understand, even when they pause, let me show you the difference between the stock market and the economy here, folks. You see that pause right there? When they did that pause, I think it was 06, 07, the stock market went up, okay? The same thing you're seeing now, because what have we been doing? They've been sitting here anticipating this pause for months, and the stock market's been rallying, okay? And I just have the Qs up here, not the S&P 500. The S&P 500 goes back even farther and shows what we're talking about and stuff. But I'm telling you, when you see it, and of course, right there for the dot-com bubble, that was the one where when they actually paused, the market was already going down even before the pause, because the dot-com bubble had kicked in. A lot of companies were going out of business. It was a hot mess. And so in 2018, it was the same thing, right? As soon as they anticipated that pause, the market went up before they ever paused. And then when they paused, it went up. And so that's what's happening now for sure. And understand, when they pause, who knows? We're going to see how long it takes to get all this money out of the system. That's what they're trying to do. The market can still go up, folks. So just keep that in mind, okay? What we don't know about is the earnings part, which we're going to find out. Again, the year first. Now, this chart right here, when you go on there, make sure you go logarithmic. Logarithmic just kind of smooths out the chart. Now, when you look at this right here on NASDAQ 100, for example, when you draw this up, look what you get. You get the bottom of the '08 crash. You get the bottom of the 2020 crash. You get the bottom that we hit in October of 2022 as well. Okay. When we go, let's go ahead and put another line on here. Let's go to the top part. When we go to the top part, you can plain as day see right here, obviously it moves up, and I mean many touch points on this one on the way up. On this chart, we broke through it. It took us putting what, $8 trillion into the economy or whatever it was in the world or something to actually break through this. But it's the only time we've ever broken it, right? Is the 2020, 2021. Obviously last year brought us back down. We bought back up, but you can look at this and you go, okay, well, there's all-time highs on the NASDAQ 100. Or you can also call it the QQQ if you want to. And when you look at this, okay, well, let's just say things get really bad. And let's say these effects as far as the balance sheet runoff on the Fed and interest rates finally start to take hold or whatever, and consumers start to get really weak. Well, where are we dropping to? Since we hadn't busted through the line yet, we could. Well, it could be 18% if it drops straight down, but that's not likely, right? And, compared to the 38% drop we had before. But then, of course, let's just say realistically it's kind of moving sideways. Maybe it trails down some at some point in time. About 14% or something. So not even that big of a drop when you compare it to what happened before. Now, you could play around with it and see, if it moves up to that top line, what's going to happen there? We get a rejection, right? We're going to have most of the time. Ours is going to be another moment where we bust through it. And looking at that, in order to actually get to the all-time high, believe it or not, hitting that line, that is the all-time high. If it moves up within the next probably week or two, and actually the next 30 days, you're going to get the all-time high right at the top of that line. We'll have to see if it rejects, but it gives you a good idea to play around with and see okay, this makes total sense, and to use it going forward, right? So, okay, we haven't busted through the line since it started in '08. Eventually that most likely will happen. It is a year first, okay? But at least it gives you something to look at and stuff. You can do the same thing with the S&P chart. So, logarithmic charts can be fun to play around with and give you a good idea and stuff. So just a FYI on that one. And so, again, this data I'm just putting out there to you to make you aware of it. Also, I like your feedback to see if you're actually seeing the same thing out in the real economy, because I like real-time data as well, because a lot of this data doesn't get updated. It's either quarterly or monthly, somewhere in there. So it can be outdated sometimes. So, but to me, it's good to know it. I want to know it because I know the market's looking at this kind of data as well. They're also looking at, inventories versus new orders and stuff, right? Or new orders minus inventories is what they're looking at as well, which I'm looking into as well, because that shows whether we're really growing or not growing at all. Okay, and so I'm going to be looking at that as well, and so we'll take that in consideration. But just want to put that out there to you. Hey, if you got anything out of it, hit the like, subscribe button. If you got anything to share when it comes to that kind of data, put it down in the comments. I always love it. I know everybody's having a good hot debate about that kind of stuff. So just let us know. All right, guys. So end up seeing you tomorrow for setting up the week coming up, because we got a boatload of earnings coming up. Economic data, not so much, but earnings, oh yeah, we got some big ones, real big ones. And so we'll look at some charts as well and some other news. So hope you guys have a good one, and I will see you later.